very lucky to have George Pearkes with us. George, you're self-muted if you could hear me. If you could turn the mute off.
Hey, Dale, how are you?
There you are, George. Thank you so much for joining us today and addressing our community on a busy day. I just want to, I'm going to be showing your, I think it's a blog post that you have here, buddy. Let's see. I'm going to take the controls here. Okay, I like the sign, gratitude. George, you can't be depressed if you could find one thing to be grateful for.
I totally agree. That's a billboard that's in the Bronx, visible from the Metro North line. I used to ride past that every day on the way to work when I was still up in New York, and it's a great message. I don't know who put that up, but it's awesome. Yeah,
and why is the E backwards? Any idea?
I have no idea. All I know is that that's a billboard in the Bronx.
Okay. Well, George, just want to introduce you quickly to the community. You can follow George, and I recommend it. He has excellent insights into the macro. He's a macro strategist at Bespoke Investment, so you could follow him on Twitter at Pearkes, and then his blog will come up. And I do want to talk about a little bit later what you were discussing here, NAIRU, which I'm not familiar with at all. But why don't we start it off with what everyone's talking about, and that's the dramatic sell-off in the FANG stocks on Friday, George. Is it a harbinger that we're finally going to see some type of retrenchment pullback in the market? What are you telling your people at Bespoke?
Yeah, so I think it's important to remember that two things. First, that the U.S. tech sector had sort of led globally for quite some time and had really gone parabolic. As of last week, we had a 14-week RSI reading on the NASDAQ on the NASDAQ composite that was, sort of the 95th percentile of historical readings. You pretty much had to go back to the tech bubble to see something comparable. And we took a look at what that meant for the market, and it's not a good indicator of what comes next. And in fact, in similar, high weekly RSI readings for the NASDAQ, you tended to see actually outperformance over the subsequent, 3 months, which is counterintuitive, but speaks to this idea that markets do tend to trend, and high momentum to the upside or downside doesn't necessarily mean that you're going to see a reversal. So something to keep in mind in any asset, that stuff does tend to trend more than you think.
You mean like Bitcoin? You never know how long a rubber band could stretch before it snaps back?
I think in almost any market we can say definitively, well, it can only go so far, but how far is so far is just, it's almost impossible to know. So looking at it historically, speaking to the current sell-off, we came into last Friday with really overbought conditions in the NASDAQ, and sometimes that led to decent-sized sell-offs. In the case of the let me pull up the specific data we have here so I can read it off to your listeners. But
what really struck me, George, is not that we had a sell-off, but the velocity of it, and that within 8 or 10 seconds, Amazon lost 10% of its market cap. And I'm wondering what your view is. There have been a lot of comments over the last few years that market structure isn't as strong as it used to be because we don't have market makers. They took away the incentive when they decimalized it, and we're being run by the machines, and it could be a harbinger of all this. If there was ever a program in the spiders, something like that could repeat in the spiders. And did that bother you at all, that it was a second break? No?
No. Okay, so the market structure stuff is sort of, I would talk with the market structure stuff as sort of independent from long-term returns, right? I don't think the market structure stuff has any impact on long-term returns other than lowering costs for typical investors, especially small investors. So you're absolutely correct that market makers are having a harder time stepping in, especially in something like equities, because of balance sheet constraints and how a variety of new regulation has treated those in terms of capital cost. That said, that's a valid observation, but I think that if you're an individual investor, that means that you may have to alter your trading strategy in terms of high frequency, strategies. But for the average person, that's an unmitigated good thing. And the reason for that is that the average person is going to be long the equity market in size for 30, 40 years. And day-to-day moves, minute-to-minute moves do not matter. They don't matter, right?
Does stop losses matter, George?
Well, it depends on your trading strategy. Again, for the average person, stop losses don't matter. I realize
because they don't use them, right? Because they don't use them.
They shouldn't, right? For this audience now, the folks listening, it may be a totally different story, and I totally understand that. Okay. Higher frequency active individuals, it's a different story. But for the average person, the idea that liquidity has gone down means that the cost of liquidity has also gone down, right? It's an incentive thing. And, I think that's an unmitigated good thing.
The glass is half full.
I would say so, yes. Now, for active individual investors, if you are leaving stop losses that are automatically triggered, if you're not doing limit stops, you're just doing market stops, you're gonna get hit. And we would tell anybody that they should be using limit stops, no matter what kind of investor they are, because this idea of flash crashes, however you define flash, whether it's a couple days, a couple hours, a couple minutes, a couple seconds, we like to think that it's all because of the computers, but this sort of activity did happen previously, right? These sort of departures from fair value due to liquidity concerns. I mean, there's a little shop called Long-Term Capital Management that blew up for exactly that reason. They were ultimately correct in most of their trades, but they couldn't hold them because the market moved against them in an illiquid way. That was in the late 1990s, and the markets they were dealing in were not totally automated, were not, ETF driven. They were individual people on phones usually trading bonds. So, I go
back that far with a green Quotron machine on their desk.
Well, whatever. 1987, portfolio insurance drove a lot of the crash in 1987, and that was in large part automated. But the market wasn't massively long ETFs, passive investment vehicles, that sort of thing. It was almost entirely humans behind desks making decisions. So, I just
point well taken.
Yeah. Now again, for individual investors that are active in the markets from day to day, that are using leverage to manage to juice volatility and, approach investing that way, which is a totally valid thing to do. When I say the average person doesn't behave that way, I don't mean all people should behave that way. I just mean that, we know what you mean. Yeah. So I don't want to cast aspersions.
No, we know what you mean, because a lot of people were better off that, if they just went to sleep during Brexit, and for sure if they were asleep after the evening of the election win for President Trump, they were better off not being up that night and seeing it lock limit down, better off waking up the next day. And, I'd like to shift it a little bit, George. A lot of people, emerging markets were out of favor for years during a strong dollar period, and a lot of our work shows that the dollar's in a pretty critical area that it has to hold. Do you take the dollar into consideration as to where you're going to invest? If you think the dollar's going to be weaker, that's going to favor multinationals over the Russell, seems to do better with a stronger dollar?
Yeah, absolutely. So we've done a lot of work on this, and we actually have an index of the Russell 1000 that we break into companies with high international exposure. So that's companies that derive more than half their revenues from overseas. Generally overseas, sometimes that means outside the United States, sometimes that means outside of North America, but generally speaking, that means ex-US. The other side of that index is the percentage of companies that derive greater than 90% of their revenues from the United States. So we split that into internationals and domestics respectively. Internationals more than half their revenue overseas, domestics more than 90% of revenues from the United States. And one of the things that we'll tend to see is during periods of strong dollar, the domestics will outperform quite significantly. So because those domestic revenues aren't sensitive directly, they're second order effects, but they aren't sensitive directly to the dollar, whereas the rising dollar reduces, just forget about what it's doing in local currency. If it's unchanged in local currency, it goes down in US dollar terms for internationals if they have a high revenue exposure. So what we found is that there is a decent correlation between the spread of performance for those two sets of stocks and the price of the US dollar. And what we've seen this year is we've seen a lot of the sort of domestic type trades, concentrations in energy, in industrials, in consumer discretionary. Those types of trades have really underperformed versus their strong performance late in 2016, because in 2017 the dollar really hasn't done much other than go down, right? The
What do you make out of a lot of the Trump trade being unwound almost back to the levels they were at in November before the recent bounce in the bank shares?
I
the bonds are trying to rally back to where they were before the election result. What do you make of that?
I think we all love narratives, and I think the narrative of, okay, we've got a unified legislature and presidency in terms of party, and those folks are going to be likely inclined to cut taxes and disregard the deficit. That was sort of a great narrative that the market really liked, and it played out in a big way. And now we're sort of, supporting that narrative was this, this very synchronized acceleration in global activity that dates back to the middle of last year. You had China, Japan, Europe, the U.S., EMX China, all take off at the same time, and all sort of head upwards within their cycles simultaneously, which is something we hadn't seen since like 2011. So that as well supported this narrative of short the bonds, long the dollar, long corporate activity, S&P 500, global equities, however you describe it. What we're seeing now is, especially led by U.S. data, a reversion of that acceleration in global activity that dates back to last year. The U.S. Economic Surprise Index has led all economic surprise indices lower. Everything's sort of rolled over and is missing estimates to a slightly lesser degree in Europe, but true across all major economies. On top of the fact that the Trump administration has delivered no significant legislative wins so far. And when I say no, I mean none.
You think they will?
Well, I would be inclined towards no, but I think you can make the case that they'll do something on taxes.
Okay.
At the end of the day, though, the pricing that a variety of assets demonstrated, in late Q4, early Q1 of this year required big substantive change right away. And I think it's fair to say that that's not happening, right? We may get tax reform in some way, shape, or form. We may get the AHCA passed in some way, shape, or form. We may get some sort of infrastructure spending, but it's not going to look revolutionary in any way, shape, or form. It is not going to, right? We know that for a fact. So it makes sense then that a lot of these assets will be reverting towards the sort of levels that prevailed in 2016, maybe 2015, less aggressive expectations around or price levels for inflation, less aggressive yield on the 10-year, less aggressive dollar valuation, so on and so forth. So, that all kind of makes perfect sense from a policy perspective.
All right, you brought up the oils. You have a view on any commodity plays, oil being depressed, every OPEC agreement, we get some nice jawboning. We've been stuck in a range. We're threatening the bottom of the range in WTI. Gold looked like it was trying to break out a week ago. They turned the gold back. Anything you're seeing in the commodity basic materials area that looks hopeful or could be a good play because it's undervalued?
Yeah, I would take these three in a row. So I'd start with oil and then talk industrial metals and then talk precious metals. So for oil itself, the thing that I've noticed so far this year is that we are just trading in such an emotional, temperamental way with regards to OPEC. The a good outcome gets priced in ahead of every OPEC chatter, and then it gets priced out quickly afterwards, and people are just swinging it back and forth in that respect. Technicals have played a substantial role as well, but really it's about how people are getting positioned ahead of and out of OPEC chatter. And that's hard to trade if you're not, keeping a close eye on everything that comes out of a variety of different countries. Taking a step back for oil, at the end of the day, we are not going to see $100 oil anytime soon. There has been a really big repricing, and I'm sure everyone who's listening right now is aware that the swing producer is no longer OPEC, right? The swing producer is somewhere in the Permian Basin. Yeah. And as long as that's true and that oil supply is more elastic than it has been in the past, you're going to have suppressed oil prices. Now, the caveat to that is the fact that the marginal supply may be very price elastic, but the total supply is still very inelastic. So when you're talking about mega projects in non-OPEC producers, non-OPEC, non-US producers, when you're talking about offshore production, you're talking about extremely large CapEx requirements to maintain output, let alone develop new output. And demand has been fairly consistently growing. So eventually we're going to get to a place where the swing producer is no longer in the shale patch because the shale patch's capacity can't make up for the consumption of offshore and non-OPEC, non-US capacity through consumption and the consumption of the investment.
That could take a while to develop. We're talking like we could be talking years, can't we?
Yeah, no, absolutely. It's not in the foreseeable future. That is a 1 to 5 year story. If we see really strong demand growth, it could come as soon as a year. If we see slower demand growth, it could come further out. But at the end of the day, the shale patch will not be supreme forever. It is right now. So with that in mind, as long as the shale patch is the swing producer, $100 oil isn't happening anytime soon. And it's going to be a question of how fast the fields outside of OPEC and outside of U.S. shale patch are consumed through natural attrition. That's going to be the function of when we switch regimes again. So for WTI, the way I see it is trades very emotionally. If you're using a pure technical strategy, you can do okay. If you're headline watching OPEC all day long every day, you can do okay. Just by sort of being contrarian, saying, okay, market's going to get bullish as we head into OPEC and then bearish out of it. If you're sort of taking a longer-term view, it's really hard to figure out what the timing of that next rebalance is going to be, and I don't have a strong view beyond a couple years out, and who knows beyond that. So that's how I look at oil.
Okay, how about let's go to the gold and the precious metals. I was taught, George, I don't know if you agree with me, but as a commodity trader, I was schooled that the shares should lead the way of the underlying commodity, and the shares, even when gold was having on the verge of a major breakout that everyone's looking at, even like Carter Worth, everyone's showing it like a 20-year symmetrical triangle, the shares have been underperforming the gold. So where's your head at on gold in here?
Yeah, so I don't look super closely at miners versus underlying commodity for the precious metals. My sort of approach to precious metals is that they are essentially a real yield targeted instrument. So gold is essentially a 2-year real yield instrument, similar to 2-year tips. And if real yields are headed up, gold is going to underperform, and vice versa. Because you're talking about a dollar interest rate relationship there is an inverse relationship.
You're talking about opportunity costs. Like when it was really smoking when we were moving towards negative yields last year.
Exactly. So yeah. So if real U.S. dollar yields are dropping, gold should be rallying, right? It's the same thing as the 2-year tip, 2-year tip bond. Well, it's a note, but you know what I mean. Roughly, I mean, you can change the time frame on that, but the general feeling is something close to that.
Do you like them? Do you like them, or is it an avoid for you?
So I think to have a view on gold, you sort of have to take this U.S. interest rate view and sort of a U.S. dollar view as well. I think the dollar has gotten really cheap against interest rate differentials. So if you were just looking at 2-year yield differentials, and I like looking at swaps and the Bloomberg U.S. dollar index, that's sort of my go-to. The dollar is like 3 to 4% cheap right now, and there's not a lot of justification to sell it off further. And typically U.S. interest rate or the interest rate differential leads the dollar itself. So it's strange to see the dollar, you know, potentially leading a move in interest rates as opposed to the other way around. With that in mind, I mean, I think you could take the same approach to gold. You know, I think gold right now is not really attractive or unattractive. I would probably be biased against it because I'm slightly biased towards the U.S. dollar being a little bit too weak. But I don't have an extremely strong view on it.
Okay, well, since you're talking about yield spreads, it's Fed week. Give us how you're wrapping your head around what the Fed is doing, what impact it's going to have on different markets. Will a Fed rate hike continue to flatten the yield curve? If they go too far, could it invert?
So I don't think we're anywhere close to a curve inversion. You know, it would be strange to not have one ahead of the next recession because that is an excellent recession indicator. But we're currently, what, 110 bips or 100 bips on 2s10s?
Right.
I can't remember off the top of my head. That's a lot. I mean, that's 4 rate hikes without the 10-year moving up at all, right? Which, you know, we'll eventually have to start talking about curve inversion, but we're so far away from it. It's not something I need to worry about.
A few years, you think?
I have no idea.
Okay.
You know, because what you have to do is you have to forecast not only the
direction of rates, but the curve.
Well, you have to have a forecast for both the 10-year and for short rates. I think if the Fed hiked 4 more times, the 10-year would probably rally a bit. The 10-year yield would go up a bit, right? So at least a little bit. I don't know. Currently, well, you know, I don't think we need to worry about curve inversion right now. It's a conversation for a later day. How
about the fact that this might be a failing rally in the bonds? I use TLT as a proxy. We topped last year, you know, I'm a technician that left a very rare formation, an island top formation. And then on the last interest rate increase, we've had this rally. We're retracing 50% or so. I think there could be more left. TLT has a gap around 130, but I don't think we're going to make new highs in the bonds, which means I don't think we're going to take out the low yield. Maybe we trade under 2, but would you view if the bonds got under 2 as it being selling? If you own bonds, you should sell them, get out of them, and move into a different instrument?
Yeah, I think sub 2% on the 30-year yield, for instance, would be, I mean,
10-year.
Yeah. Oh, okay, so you were talking TLT, so that's the long end.
Oh, yeah. It's 20.
10-year, yeah, 10 or 30 below 2% is too low. The economy is not bad, right? Like, I know I said earlier, okay, well, economic surprise is rolling over and the U.S. is leading that, and like that's a good reason to sort of fade the Trump narrative, or that's been a good reason to fade the Trump narrative. Okay, fine, but like the economy is not going to fall apart. You know, barring some massive shock that we can't predict. So, for instance, an asteroid falling or something like that, right? One of these things that there is no way to model for, that could tip us into recession. There's no question.
A conflict, a hot war in Korea.
Sure, something like that. Yeah, absolutely. But but if you're looking at economic inputs and outputs only, and you're sort of saying, okay, well, we can't model those true black swan. Let's forget about it. So if you do that, I mean, I think it's easy to make the case that we don't go into a recession before the end of 2019. You know, I don't see the imbalances in the U.S. economy that would require a recession to cure, and that sort of, you know, that is what you need. And you know,
you don't think the fact that housing prices have recovered above the 2008 peaks is an imbalance?
No, I don't, because they're not moving drastically out of sync with rents, right? You know, that doesn't mean that rents are inherently right, but if housing prices are moving up roughly in line with rents, which is something that the Fed looks at quite closely post 2007, 2008.
That's interesting.
if that's the case, then okay, well, rents are too high. That means we have insufficient. That's a supply side problem. That's not a demand side problem. That means CapEx is too low, right? Like fixed investment in housing is too low, and that's true. If you look at fixed investment in housing relative to GDP over the last, since World War II, we are still super low, and we're super low in aggregate fixed investment relative to GDP, and we're historically low in aggregate government plus private net fixed investment, so backing out depreciation. Extraordinarily low versus history. So, with all that being the case, it's really hard to have a business cycle roll over if you haven't built too much of something, right? That is what a business cycle is
Just we had too many malls.
We have
too much oil, too many malls.
There are individual sectors that have had supply corrections, and oil is a great example. But there is nothing that's large enough relative to the economy that's seen overinvestment go to the point where, okay, well, it's too big. If malls are overbuilt and consumer spending rolls over, then yeah, that's a big problem. But like we saw with oil, if malls are overbuilt and we have a supply contraction in the amount of available real estate, but aggregate consumer demand is holding up, that's just shifting revenues between sectors. That's not actually, destroying economic growth. So, I think that's really important to keep in mind. Like, there's no reason to think that the consumer is going to roll over. And so if you're purely seeing, micro-scale sectoral imbalances in, first it was mall, or first it was oil, now maybe we'll see malls, whatever the case may be, the economy can digest that without going into a recession. Like that's really important to understand, that the economy is way more versatile than, oh, well, something's contracting, and that means we're going to go into recession. No.
Yeah, we're not over-leveraged in anything to the same degree we were,
We are not. The Fed released its flow of funds report last week, and, it's a little bit improper to scale by GDP, but it's a convenient way to do it. Aggregate domestic all sectors debt, so that's financial sectors as well as households, as well as businesses, everyone. Aggregate domestic sector debt, it includes government, it includes state and local government, has continued to decline. It made new lows relative to GDP in Q1. So, I have a really hard time digesting this.
So most of your clients, nothing's changed. Stay the course, sanguine, no problems, or even a potential recession for a few years. Can you I know this might be outside your wheelhouse. What do you think about this mania in cryptocurrency?
Okay, so I'm not a cryptocurrency expert, so I just want to usage with that. It's not really my bailiwick.
Okay.
But
I figured it wasn't.
Yeah, but we do get questions on it. I do keep an eye on this space a little bit. Cryptocurrencies are not going to replace the traditional currencies, right? That's not going to happen, right? And there's a lot of reasons for that. The easiest to explain reason is the fact that any transaction into currency, so you're converting US dollar or euro or yen or Chinese yuan or any currency, if you're converting into cryptocurrency, you're leaving a paper trail. Like, governments can find that, right? So using it at a large economy-wide scale requires governments to say, okay, we're cool with this. Now, I get that people think that it's a great alternative for moving around currency in the dark, for moving around value in the dark. So, for instance, capital flows out of China, whatever. Keep in mind that relative to the size of total payments or total economic value exchange, that cryptocurrencies are still a rounding error. It's not an issue. If everyone decided en masse, okay, we're going to switch all of our economic activity to cryptocurrencies, first off, I think that'd be a bad idea because the supply is fixed, and fixed money supplies are horrible for economic growth. But did
you write a letter to Prime Minister Modi of India about that?
No, I didn't.
What do you think about that draconian move?
So that particular I would distinguish that move because what they're doing there is they are forcing a black economy, so like what is going on in cryptocurrencies, into the light. They did confiscate wealth effectively in doing it, but that you have to question whether that wealth was ever real wealth anyways, right? If you're doing transactions and accruing value outside of the government's ability to tax and the government's ability to keep an eye on you, you're asking for trouble. I know there are a lot of libertarian sort of leaning folks who would say, well,
Right.
governments don't have a right to tax everything anyways, whatever. Okay, well, in the real world, like in reality, that's not how it works. if you're thumbing your nose at a government's ability to tax and a government's ability to keep an eye on what's going on in the economy, you're playing with fire, right? I mean,
Yeah.
that's just the way the world works.
Good
I think
advice.
ultimately that the demonetization move by Modi will be very positive for the Indian economy. You know, there is so much demand, and they've got great demographics relative to the rest of the world, that I really think everything they can bring into the light of the formal economy, where people pay taxes and are subject to the same laws as everybody else, is a positive. You know, I don't think it's a bad thing. It did cause a demand shock in the short term, but it's something that will work itself out and ultimately be a very big positive in the long run.
Well, I want to take it back to the beginning of our interview, and the word is gratitude. I want to thank you, George, we covered so much here in such a short period of time, and, you know, you're so eloquent with your views and everything. I encourage people to follow George Pearkes, at Pearkes on Twitter, and at Bespoke Investment. Are you guys registered investment advisors?
Yeah, we're registered. We're registered investment advisors, and we also sell our research as well. So if you guys are interested in that, the website is bespokepremium.com. You can do a free 2-week trial without a credit card just to see what we're all about. And if you have any questions or if you'd like to learn anything, our Twitter handle is @BespokeInvest, or you can talk to me at Pearkes. That's Pearkes.
Thank you for your time today, George, my trading warrior brother. I wish you the best rest of the year. Okay?
Thanks very much for having me on, Dale. I'll talk to you soon.
All right. Great, George. That's George Pearkes. Everyone thank George, and thank you, F.A.C.E, and happy birthday, Steve, and thank you, Velu, and thank you, Blake Morrow, and thank you, everybody. I'll see everyone for Turnaround Tuesday. Have a great afternoon. Only a few weeks left in spring, maybe 1 week left in spring. Take it easy. And remember, don't just count your pips, count your blessings. Find something to be grateful for. I won't jerk any tears, tear jerker. But you're not going to be depressed if you have one thing that you're grateful for. So I'm grateful for this time that I have with the ForexAnalytix team and with all of you. Enjoy your day, and I'll see you for Turnaround Tuesday. Thank you, Dave, Nuno, Dave. See you guys, Glenn. Adios.